Welcome back to the channel. This is Power of the Dollar. Today we're discussing mortgage prepayments, and there's a lot of discussion around this nowadays, especially with many new buyers having higher interest rates. And you can see here in this graph over on the right, this is where most of the buyers are getting their rates today. And if you don't know, this is a quick explanation to explain the relationship between banks, buyers, and the home that they're buying. Buyers typically do put money down, but they're gonna need a mortgage from a bank to pay off the balance of the agreed upon sale price. And now those buyers can move into the house. But over the next 30 years, they'll be paying back this mortgage on a monthly basis. And this monthly payment will consist of principal and interest. Now, this is where things start to get interesting. Let's say that these same buyers we're talking about purchased a home for $700,000. Let's type that in. Let's also say that they put down $200,000. This means that they're going to need a mortgage of $500,000. Now, let's also assume that they've got a 30-year mortgage, which is pretty common, and that they have a 6.5% interest rate, which is also pretty common nowadays. So now that we have this calculated, let's take a look at what the monthly payment will be. You can see that the principal and interest will be $3,160 a month. This doesn't include property taxes or insurance. We're only discussing principal and interest because that's what will be going to the bank. Now let's take a look at what the breakdown of the first monthly payment will be. Here we are, September 2024. We have two columns, principal and interest. You can see that only $452 of your first monthly payment out of that $3,160 will actually go towards your principal. The rest will go towards interest. Let's take a look at October. It's not much better. Only $454 goes towards principal and the rest towards interest. And in your first 4 months of having this mortgage, you can see at the top there, only about $1,800 goes towards principal and almost $11,000 went towards interest. You're probably wondering, how in the world am I paying so much in interest? On paper, yes, your mortgage rate is 6.5%, but that's an extremely misleading figure. There's a term called the effective interest rate, or more commonly, your true interest rate. And now I want to show you what the true interest rate of this mortgage is compared to that alleged 6.5% rate. And it will make sense why so much of your monthly payment is going towards interest. So to help wrap our heads around this, let's review some simple math. Once again, the mortgage is going to be for $500,000 and the mortgage rate is 6.5%. When we multiply those together, we get $532,500. Now, what this math shows is that you should be only paying $32,500 in interest. But when it comes to your true interest rate, this is 100% incorrect. And what I'm about to show you will certainly raise some eyebrows. Here we are now back at this mortgage calculator, and continuing on with the same example, we have a mortgage of $500,000 over 30 years at an interest rate of 6.5%. But look across that top bar under summary. What you will actually be paying in interest is $637,722, not $32,500 as the math calculated out to previously. Unfortunately, this is how amortizing loans work, and mortgages are amortizing loans. This means that the true interest rate of this mortgage is 128%. Yes, you heard that right, 128%. And you can also now see that the total interest paid over the course of 30 years actually exceeds the total mortgage principal amount of $500,000. How crazy is that? And yes, eventually, more of your monthly payment will go towards principal compared to interest, but that won't be for nearly 20 years into this 30-year mortgage. And the last thing I'll show you, not to continue on with bad news, but take a look at the right-hand column right there. At 20 years, you still wouldn't even have paid off half the principal still owed on this mortgage. So now that we understand the true nature of mortgages and all that interest they expect us to pay, let's discuss how mortgage prepayments can actually leave more money in your pocket in the long run and accelerate the dream that we all share of financial freedom by no longer having a mortgage. And just a quick disclaimer, we're talking mortgage prepayments, and believe it or not, some banks have mortgage prepayment penalties. It's extremely rare, but this is something you should definitely research and look into. Now, with all that done, the first part of mortgage prepayments is to understand how the monthly payment is actually calculated. Now, don't look at this and exit out of the video. All we're looking at is P, and that stands for principal. And this is where the compounding power of mortgage prepayments comes from. And M right here, this means your monthly payment. And sticking with our same example from this entire video, that will always be $3,160 until the loan is paid off. Now, if you lower P's value, you can start to turn the tables on this calculation, because as the value of P gets smaller, the value of interest being paid for your monthly payment will also get smaller. And if you make a prepayment of even $100 a month, you'll lower P's value, and this will, in turn, make it so that less of your monthly payment goes towards interest and even more will go towards principal. And as the months go on, this ratio of principal and interest will continue to lean in your favor, and it will start to snowball and accelerate. And this snowballing effect is better known as a compounding effect. So let's take a quick look at this compounding effect in Excel. So this is what's called a loan amortization schedule. Simply put, it's just a visual on what your monthly payments are going to look like and how much will go towards interest and how much has gone towards principal and all the running totals. And this is a template that's available on Excel and has all the formulas already formatted for you. This is very easy to use. So now continuing with the same example we've been using in this video, we have a mortgage of $500,000, interest rate of 6.5%, and the loan term, it's a 30-year mortgage. So a 30-year mortgage with a payment every month, that equals 360 payments over the course of this loan. So keep that in mind, 360, and we'll scroll down the bottom here, you can see 360 payments will be expected over that 30-year period. So let's say the first payment will be due today. And now let's type in $100 in this extra prepayment. But before we do, I want to highlight this box right here so no one misses it. Keep your eye on this. Now, this is the total interest that we're expected to pay over the course of this loan. We covered this earlier. Now, let's add that $100 into this prepayment column. See $100 of early payments. And now we've reduced the total interest paid over the course of this loan by $595. Even just one prepayment of $100 is going to save you nearly $600 in the long term. And let's say you had the money and you were able to do $200 of a prepayment. You'd be able to save yourself $1,190 of interest in the long term. Now, I want to show you one quick thing. Keep your eye on this right here, principal, all right? Now I'm going to undo this. Now there's 0 prepayments. And the principal goes from 452 to 454, 456, right? Now, remember that 454 right here, all right? I'm going to put that back. Now it's 455 and a half. Now this principal has gone up. This formula that we talked about before has gone up $1.50 a month. And this was 456, now it's 458. And now, even though it's just $1.50 more and almost $2 more here, all that adds up, all that snowballs, all that compounds. So even that's how over the course of this loan, you're going to save all that interest, because all of this little bit more going towards principal is once again going to skew that calculation in your favor to pay a lot less interest over the course of the loan. So the final scenario I'm going to show you is a very common mortgage prepayment tactic that many people use. And this has saved them tens of thousands or even $100,000 or more over the long term. And there's 2 simple parts to it. The first part is consistent small monthly payments. And the second part is additional payments whenever you fall into lump sums of cash. And this applies to many people. So I'm going to go over both of these and you'll see that this could definitely apply to you. Now, one thing to note, when you do make an extra prepayment, let's say $100 right here, it's not that easy to get that money back. Say, compared to if you put this $100 into a savings account, you could just transfer it back and forth. So that's something to keep in mind. And with that being known, people will just put a little bit towards the mortgage every month so that they're still saving on that long-term interest paid without having to tie up all their free money. So what I'm going to do now is type in $100. That's it, just $100 into the extra payment column, and we'll see what this does. Okay, as you can see here, this is just $100 a month has done something extremely drastic, all right? So the total interest paid here is down a whole bunch. It's actually down almost $66,000. Originally, for the course of this loan, we were supposed to pay $637,722 in interest, and we're already now just a hair above $570,000. So that's going to save you just $100 a month over the course of your mortgage. Just $100 of prepayment a month is going to save you $66,000 in interest. And it's also going to do this. Check this out. Originally, you're supposed to pay 360 payments, and now we're down to 329 payments. So let's say that's 31 payments. That's almost 3 years worth of payments, or at least 2.5 years worth of payments, meaning that you'll pay your mortgage off 2.5 years early in this scenario by just putting $100 a month. Now, I'm going to go over the second part of this, making additional payments whenever you get lump sums of cash. So 2 very common times that people will get lump sums of cash are your tax return and an annual bonus. Now, the tax return typically happens in March. That's when you'll get your refund back, or April, depending when you do your taxes. We'll use March for this scenario. And then usually your end of year bonus comes around Christmas time or December. So I'll put that in there. And for both of these, I'm just going to do a very even round number of $1,000. All right, took me a little while to manually input all of this, but what I did is I put a yellow box over December and I put blue boxes over March. I did this throughout the course of the whole loan. In December, this marks when people may get a year-end bonus from their job. In March, this marks when people may get a tax refund. Now, I obviously know that not everybody gets a bonus or refund, and everybody's employment and tax situation is different, but what I'm showing you here is just how to use this free template on Excel so that you can apply it to yourself and input your custom numbers that apply to your financial situation. So to keep it easy, I put an extra $1,000 into every December and March to reflect extra mortgage prepayments that coincide when people may get extra lump sums of cash. So first, let's look at how many years we've saved on actually having to pay this mortgage. So if we elect to do this prepayment plan, we would have paid this mortgage off 70 months earlier. Remember, it was 360 total monthly payments, and we're down to 290. And this last one was just a partial payment, right? So 70 months is just under 6 years. So we'll call it, say, 6 years to make this easy, okay? You've paid this off 6 years early. Now we'll come back to the top. You can see that the total interest paid over the course of this loan has been reduced by almost $150,000. So not only will you achieve the feeling of financial freedom sooner by paying off your mortgage 6 years early, but you'll also have saved $150,000 in interest payments. And the best part about all these savings is that they're tax-free. So essentially, this is a tax-free investment of about $150,000. And yes, paying off debt is an investment. And some might say that taking this money for the mortgage prepayments and investing it in the stock market or other investments is the better option, and they might not be wrong. It all depends upon the math and how much interest you may be paying over the course of this loan. And when you're starting to do mortgage prepayments, say that you've discovered this 5 or 6 years or 10 years or 20 years into your mortgage. It's all a math problem. So to look into this further and help you decide what the better option may be, I'll be making an advanced math mortgage prepayment video that covers this exact discussion of doing prepayments versus investing. Neither option is wrong. Like I said, it's all just simple math. With that being said, I know this video covers a lot of information, and if you have any questions, drop a comment below. This is something that we all should have learned in school, and unfortunately, most people don't learn this until it's too late. It's on us as individuals to create our own destiny that consists of financial freedom. If you found this video helpful, please give it a like. Also, don't forget to hit that subscribe button so you can be notified of all my upcoming videos. And if you have any thoughts or questions, leave a comment below. A lot of time goes into making these videos for you, and I strive to deliver the most valuable information in exchange for your time. So for that, thank you very much. This is Power of the Dollar, and I'll see you next time.